We at Luxo-Life love bringing you content that is mainstream and not so mainstream. So this video is meant to educate you about gold, and if you want to buy some, you need to talk with your financial planner first. Not just listen to our channel, no matter how much we want you to succeed. A good financial planner will help you navigate all this ocean of information and get you where you want to go. So, our lawyers want us to add that this video is for entertainment only. Okay, now that we all feel better, on with the cool video. Oh gold, dear gold. Gold has been one of the most valuable resources on Earth for as long as the history of mankind's first civilizations, and while the bright yellow metal is pricey as it is hefty, many investors today are considering gold investments as a safeguard against the coming recession this 2023. While owning an actual piece of gold sure seems tempting, there are a lot of things to consider regarding the highly coveted mineral. But if you fully understand what it means to own a piece of gold, you might then consider adding it to your current portfolio. Welcome to Luxo-Life, your partner toward personal growth and success. Today, let's talk about gold value. Without a doubt, gold is one of the rarest and most expensive minerals in the world. How expensive? Say around $1,995 per ounce. Gold is insanely valuable due to its rarity and anti-corrosive properties, not to mention how hard it is to mine the ores and refine them for high-quality bullions, bars, and jewelry. Another reason why gold is so valuable is that many people desire the shining, shimmering metal. Investors, banks, and even governments all compete to seize the precious minerals and prepare for economic threats and major downturns. In fact, China is getting ahead of everybody else. After purchasing a whopping 30 tons of gold just last December, the price of gold skyrocketed. You see, the price and value of gold aren't always governed by economic movements. Instead, they tend to weigh on supply and demand. If there's more gold in the market than what people want, then the price and value drop. But if there are more people desiring gold while its supply diminishes, the price and value goes up. Investment. Depending on your ability and situation, gold can be a good hedge for your portfolio, but expect that gold won't behave as some investments would. If you buy a stock, for example, trading at $40 and you expect the company to grow 100% in 10 years, then you'd also expect the value of your stock to go up 100%, turning your $40 into $80. But gold does not act like that. It doesn't have an expectant future earning or growth prospects, so investors view it as a store of value, a commodity that is sure to retain its value for years on end because it's been proven so for ages. Gold is not always guaranteed to grow some percentage in value over time, but investing in it secures your purchasing power for future years to come. With basic economics and inflation, the prices of today's everyday items are only getting more expensive. And with the continuous rise of inflation, the purchasing power of money that each person has decreased with it. For example, with a 20% inflation rate, something that costs you $15 today will be valued at $15.30 in the next few months. Having an effective store of value, like gold in this case, ensures that your purchasing power will still be functional in 10 years as it is today. And obviously, the more money something costs, the more actual money you need. Since gold holds its value, your purchasing power is secured by investing in precious metals. That's the basics of how to see gold as a store of value instead of just another investment. But another thing you need to know is how gold reacts in relation to different economic conditions, may it be in a positive or a negative way. Economy. It's common knowledge that gold and recessions are inversely related. meaning that when there is an economic recession or a crash in the economy, the price of gold usually increases because investors would run to their nearest gold dealer and cuddle with a knight in shining armor of all their assets. During the last 3 recessions, 2020, 2007, and 2021, S&P 500 funds decreased and the value of gold increased. But as we have mentioned, an investor is not always guaranteed that the price of gold is promised to rise during a recession. For example, during the 1980 recession, gold dropped a significant 5% in value. So to be safe from any of the negatives to happen, you should be well aware of looking at the bigger economic picture, the external factors that may intervene with the rise or fall of the value of gold, and not just narrow down a couple of indicators to conduct your decision on adding a gold investment to your portfolio. Another inversely related thing to the price of gold is inflation. You might have heard of investors calling gold a hedge against inflation or an all-safe haven for your assets. This is because paper money only has monetary value because of the government, and as paper money loses its value, gold becomes more valuable as an asset. However, some research has shown that sometimes gold performs poorly during some periods with higher inflation. Around the early 1980s, gold prices went down 10%, while inflation was going up at around 6.5%. In the late 80s to early 90s, gold was down 7.6% and inflation was at 4.6%. This might have caused some shaking of heads, with experts saying that gold isn't a very safe or effective shield against inflation. But the analysis was considered flawed because the researcher only examined the inflation rate and gold value, not the entire economic narrative going on around it. So for everyone's sake, let's actually look at how the 1980s went. The US economy was deep in a recession and inflation was only going higher. But thanks to President Reagan, taxes were cut and government regulations were made a lighter burden. The government expenses on social programs were cut short and the military were given more financial support. Because of that, the S&P 500 gained close to 26% that year, then a loss of 10% in 1982. Then it went up again by 15% in 1982 and 17% in 1983. Even with the recession and ongoing inflation, the stock market was flourishing, and because of the tax cuts, Americans were able to have more money in their accounts. As a result, there wasn't really a need for gold, thus decreasing its demand and value. Interest rates may also be one of the things that have an inverse relationship with gold. And it's often true, since when interest rates rise, gold prices would go down because investors would leave buying gold for some other time and get into low-risk investments that may have a higher effective yield. But with history, in most cases, there's a positive correlation between gold and interest rates. Their direct relationship produces a scenario where when interest rates rise, the value of gold does too. Risks. But buying gold is not as easy as these investors made it look. Gold is a physical asset, so you need a storage place secure enough for you to actually own gold. It's not like you can just keep it lying around a shelf in your house. There are real risks within that you have to consider and think of carefully. And security costs money. So it's not like you can just buy gold, pay for it online, and have a record of it on your phone all the time. There's also an issue with making sure the gold you're buying is authentic and your seller is not faking you out for gain. Some dealers will also sell and buy gold at different prices from other dealers. However, gold ETFs do exist, and while they remove the risks of having to store and secure your golden treasures, to some investors, investing in gold ETFs defeats the purpose of owning real gold simply because you don't actually own any gold and you expose yourself to risks of which real gold is supposed to save you from: counterparty risks, market liquidities, and other fees. So really, there are a lot of things to consider before partaking in this wise investment. But before we conclude, we'd like to treat you to one more piece of information you should know about gold. Stability. Gold, in its financial essence, is a type of currency that remains valuable no matter the time and age. What this means is that gold is a commodity whose value goes up along with the world's advancements. The reason behind this is that gold has real value because of its physical properties. Unlike today's paper and digital currencies, whose values rise and fall depending on certain economic events, gold possesses a stable flat value that easily outperforms all other currencies. The value of gold is only affected by its demand, quality, condition, and liquidity. In the end, owning physical gold safeguards your portfolio from certain market risks and the potential loss of purchasing power, since the value of gold is incredibly stable. And while it may seem like a volatile investment, it only looks that way because of the instability of other currencies like the dollar. What makes owning real gold attractive is that it promises lifelong security for your funds, and it increases along with technological advancements and consumer prices of our world today. More so, gold can be passed on to generations to come, ensuring your offspring more financial options in all sorts of economic depressions. So, what are your thoughts on gold investments? And do you think owning a piece of this shiny yellow material is worth it? Let us know in the comments below and leave us a like while you're at it. Don't forget to subscribe for more awesome and educational videos.